Hello and welcome to the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index, and we will be looking ahead to the week that is beginning. Yes, we are in June. The week is beginning the 2nd of June. So just before I start, as always, I'm just going to ask you to read through the risk warning. Okay, so let's crack on. Just having a look, first of all, this is the economic calendar for the City Index website. I'm just going to actually start though by going through a quick roundup of what's happened last week or this past week. We've seen that the S&P 500 has recovered this week after losses last week. So we've seen the S&P 500's on track to book around gains of around 1.8%. It's also on track for its best monthly performance since 2023. Obviously, we can see here this was the recovery that we've seen from the last week's concerns over the US debt position. We've seen that recovery. Obviously, if we just go back to May time, that was around here. We've seen a strong recovery up where we are now as the concerns have eased over Trump's trade tariffs, as worst case scenario appears to have been avoided, but tariffs are still very much in focus. Even this week we saw a lot of volatility surrounding the news over whether trade tariffs would be blocked, or they were blocked by the International Trade Court. This was then undone by the appeal. So, you know, that's still creating a lot of headline risk in the markets, which is still driving the US stocks and the US dollar, as well as risk sentiment. Also this week we had Nvidia results, which were encouraging and helped to ease concerns over those Chinese restrictions, given the strong demand anyway and the strong solid revenue guidance. So that's been sort of the main focus. Obviously, we still haven't had US core PCE data, which is due to be released shortly. We did see jobless claims tick higher. We saw US GDP was also a little bit concerning with despite an upward revision to 0.2% contraction. We saw consumer we saw the consumption, consumer spending fell slightly, which is a main part of the US economy, to 1.2%, down from 1.8%. So that did just rattle some nerves. So this is the S&P 500. As I said, we've seen it up this week after steep losses last week. Quick look at the US dollar. Again, US dollar is trading a modestly higher across the week, but we did see quite a lot of volatility yesterday in light of those developments surrounding the trade position. So let's just have a look as to what we're going to be watching next week. I think one of the first things, there are several central bank rate decisions. So we've got the ECB, we've also got preliminary inflation from the ECB, we've got ECB rate decision, we've got Bank of Canada rate decision, and then we've also got Chinese services PMI, and then we've also got from the US the ISM services PMI, as well as non-farm payrolls. So quite a lot to be looking ahead to. We're just going to kick off with Eurozone inflation and the ECB interest rate. Excuse me. So inflation is expected to cool closer towards the 2% target, which is going to pretty much support the view that the ECB will cut interest rates again in the June meeting. The difference I think that we'll be watching out for here is that in the April meeting, we saw that there was very much a dovish unity between policymakers. And I think The June meeting is probably looking more divided as we get closer to that neutral rate. Now, the broad expectation is that policymakers will cut rates by a further 25 basis points. That will take the deposit rate to 2%. However, hawks at the ECB are starting to sound a little bit more cautious, suggesting that a pause in rate cuts potentially until September, given those simmering US-EU trade tensions. Just for example, Austrian Central Bank Governor Robert Holzmann, he said that he saw no reason for the ECB to lower rates in June or the July meeting. However, his hawkish comments, I think, are in disagreement with a lot of the doves at the ECB. Villeroy de Gallo said, you know, he's heading straight for another rate cut in June, and, you know, considers that any trade impact will be disinflationary in the Eurozone. So the another 25 basis point cut is needed to support the bleak growth forecasts and inflation, which is cooled, as we said, is cooling towards the bank's 2% target. Trade concerns are obviously going to be a key consideration, given that Trump has set that deadline of July the 9th for the 50% tariff. So, you know, we'll be wanting, the ECB wanting to see some agreements, or at least progress towards an agreement coming. But this is where we are. We found that the euro is actually holding on to quite a lot of those gains that it's had since the start of the year. That a lot of that is obviously down to the weakness that we've seen in the US dollar. As I said, you know, we saw that trading, you know, down at low levels here, levels that, you know, haven't been seen for several years. So part of that upside that we've seen in the euro US dollar obviously is that weakness, because given that the ECB is expected to cut interest rates, I think it does mean that the upside may be limited from here, just because of the stagnant outlook for growth, inflation, obviously close to target, ECB expected to cut rates potentially in June, potentially once more before the end of the year. And that's quite in contrast to the Federal Reserve, who really aren't talking about cutting interest rates at all at the moment, given there is so much uncertainty regarding trade tariffs, and given that the expectations are for sticky inflation as a result of those trade tariffs. So, but these are the levels to be watching out for. If we do sound a slightly more hawkish, more cautious ECB regarding further cuts, if we can get a rise above that 114 level, that's going to create a higher high, going to bring 115 and 115.75 into focus. On the downside, this is the level here, 113. So we're trading in this relatively tight range at the moment. We did see a spike down on Thursday below that sort of 113 range, but that found support before the 112 level, which is also the 50 SMA. That's also the sort of high that we saw back in September 2024. So just very much in range. Momentum's losing, we're losing power. So that does sort of support this wait and see move. Obviously, watch out for a breakout trade. That could be what we'd be looking for there. If we get a dovish sounding ECB, then look out for 113 on the downside, and then 112 for a lower low and a break below that 50 SMA, which has actually guided the price higher since late February. So whilst we're looking at the euro and the ECB, also worth just having a quick look at what's going on with the DAX. This is the DAX, had reached record highs this week with all this uncertainty and about, you know, will they, won't they, with the trade tariffs. Got to a high of 24,400. Have since come back down from that level, trading around the 24,000 level as we speak. Now, the DAX has been supported by expectations that the ECB will continue cutting interest rates, and obviously as that sort of alternative asset allocation away from the US that we have seen, although that's obviously calmed down quite considerably now. But, you know, I think Germany is being seen as a little bit of a safe haven in that respect, which has helped it rise up to those record levels. It could struggle to push too much further. Watch out on the upside, 24,500 is the upside that we'd be looking to break above, really. And the upside, as I said, it is on track. There's the uptrend is still in play. There's no concrete signs of reversal. We are seeing slowing momentum though, so that is a sign for caution. So what else have we got going on today? We've also got the Bank of Canada today. Sorry, next week we've got the Bank of Canada rate decision, and the Bank of Canada are basically, if we think about there's been a de-escalation in the US-Canada trade tensions. New Prime Minister Mark Carney is focusing on stimulating the domestic economy, but we've also got that slightly sticky inflation. And I think when we sort of take those in combination, it just means that the Bank of Canada is likely to leave interest rates unchanged in the meeting on the 4th of June. Basically, the market's pricing in around a 70% likelihood of rates remaining at current 2.75% levels. This comes after the central bank has cut policy rates 7 times since starting its easing cycle last summer, but it did leave rates unchanged also in the April meeting. Now, the outlook in Canada, I think, does remain a little bit murky. We've seen that core inflation is sticky, came in hotter than expected, and diverging, interestingly, from headline inflation. So what's going to be interesting is to see how much focus and attention the Bank of Canada place on that core inflation over headline inflation. The labour market is weakening, and that's going to be something that the Bank of Canada will also be keeping an eye on. Again, what are they going to be watching more? Weakening employment or sticky core inflation? And my hunch is sticky core inflation will be more of a concern. And then obviously there's this focus on trade policy uncertainty and the potential impact on the economy. Now, as I said at the beginning, there's sort of a de-escalation between a trade war between the US and Canada. Trump initially was quite aggressive against Canada. We've seen that ease more recently, and Canada's actually now faces one of the lowest effective rates on exports with the US and a more stable relationship. Still, I think the Bank of Canada will likely want to see how these developments impact the economy before moving again on rates. And I think the market is pricing in around 40 basis point rates worth of cuts before now and the end of the year. Now, we have seen that the loonie has been relatively well supported against that recent US dollar weakness. We saw there was a recent attempt to rise above the 200 SMA, but the fact that it remained below that 200 SMA, which is at 140, we've seen, a series of lower highs, lower lows. We've got a 50 SMA crossing below the 200 SMA. These are all sort of, point to a bearish picture. As far as levels to be watching, you've got this zone here at the 137.50, 137, sort of in this region here. We've got obviously some support. If we can get a break below that level, if we're seeing a slightly more cautious sounding Bank of Canada, slightly less dovish, more hawkish, then that could actually give a break below that level and the 137 level supported by the RSI below 50. Now, if we can get below there, I think 136 is a level to also be watching out for on the downside ahead of that 134.50 level. Now, if we find that the Bank of Canada is actually more concerned over the outlook and they sort of adopt a more dovish sounding stance, then we could see these levels, the 139 on the upside ahead of the 140, which is the 200 SMA. It's also the high that we saw in May. So if we get a break above that, that's going to create a higher high towards that 141.77-75 level. Okay, so what else? Let's just have a quick look at what else we've got going on. So we've done ISM manufacturing. Well, let's go to obviously US non-farm payroll, massive event each week. expectations are for 130k. So that is showing that jobs growth is slowing. We saw that that was the case in the April meeting as well. Non-farm payroll growth slowed to 177,000 from a downwardly revised 185,000. So, and expectations had been for 130,000. So, I mean, the market is showing that the labour market is, sorry, the data is showing that the labour market is slowing steadily. I think the markets are going to be watching very closely a bit expectations that, you know, the labour market is in, the outlook for the labour market is increasingly darkening. Now, the reason that it's increasingly darkening is obviously because of Trump's trade tariffs. Isn't everything? Yeah, those Trump trade tariffs, I think, is something that is expected to see unemployment. We've heard the Federal Reserve say that they expect to see unemployment increase as a result of the tariffs. And they've also said, obviously, that it could keep interest rates unchanged whilst it sees the impact of the data of the trade tariffs on US economic data. Now, this is the US dollar, Japanese yen. If we see sort of rising concerns over the outlook for the US jobs market, then we could expect this pair to fall lower. This pair has seen some volatility over the past week, given those trade headlines. The Japanese yen is a safe haven. It is a safe haven that's benefited from weakness in the US dollar owing to trade tariff outlooks. So if we do see weaker than expected US non-farm payroll, we could expect this pair to potentially look back down towards this level here, which is 142.10 level, which was the low that we saw this week when it bounced off that upper band of the falling trend line. On the upside, if we do find that if we get stronger than expected non-farm payrolls, which could help ease those concerns over the impact of the trade tariffs on the labour market, then we'd be looking for a rise above the 146.10 level. Now, we can see there's a fairly long upper wick on that candle, suggesting that actually demand at those higher levels wasn't really that strong. We've got the RSI pointing lower. We're below the 50 SMA. So, I mean, for me, we are in neutral territory, but it is looking potentially slightly more bearish than it is bullish. But as I said, if we get a rise above that 146.10, then that could create a rise on the upside towards that 148.65. Whilst we're always here, let's also have a look. We've got US ISM numbers coming through. They're expected to show a little bit of growth as far as US is concerned. Here we go, 52 up from 51.6. Again, I think if we get any sort of, scary numbers, that could quickly unnerve the market and raise concerns over the outlook of the US economy, which could send stocks sharply lower, given that that would expect it to hurt sentiment. So these are the levels that we're watching at the moment. We've seen that spike up higher to that 21,800. That was yesterday on those trade tariff outlooks. Potential block hasn't maintained. We're still trading in this. I would say it's a relatively clear holding pattern there. It's only been a couple of weeks since over the last 2 weeks. Capped on the upside by that 21,500, capped on the downside by around 21,000. That's what we're seeing play out at the moment. We need to see if we get strong numbers, ISM, that could help break above the 21,500 towards 22,235, which is the all-time high. On the downside, weak data, going to raise concerns over the economic outlook. watch out for a break below 21,000. That's going to bring 20,400 into focus, which is the 50 SMA. So that's what we'll be looking there. Just also, why don't we just have a look to see what's going on in gold? Because obviously with gold and everything that's going on as far as trade tariffs are concerned, we have seen a little bit of volatility, but the uptrend in gold's up around 25% across the year. It's been up every single month, but this month is actually its slowest month as far as upside is concerned, just trading 0.2% higher in May. So we have seen that slow down quite considerably compared to some of the gains we've seen in previous months. Some of that has because we've moved past worst case scenario as far as trade tariffs are concerned. We've seen that easing in tensions between the US and China. We've seen Trump give the EU some space as far as ramping up to 50% tariffs are concerned. So all that's helped the mood as far as stocks are concerned, which is why we've seen an uplift in stocks, and gold is taking more of a back seat. I think as far as the outlook is concerned, potentially, I mean, the medium-term outlook for gold, I think, is still relatively upbeat. Central banks continue to buy. I think there's still going to be uncertainty as far as trade is concerned as we head towards that sort of July the 9th deadline. Which could spike volatility in gold. And obviously, if we're expecting tariffs to be inflationary, that could also help gold, which is considered a hedge against inflation. Now, if we just have a look at what's going on here, we're actually trading in a long-term rising channel, but more recently, we're just trading below, actually, this falling trend line dating back to that all-time high. So far, we've failed to move above there, which I think is quite interesting because on the downside, it's about that sort of 3,300 level. That's sort of where we're seeing some support. Near term, we could find that we see more weakness in gold if we come across sort of upbeat headlines. If we see inflation cooling in Europe, as I said, we've got the US core PCE today. And then that could help gold fall back towards the sort of 3250 level, which was the low of this week, and on towards the 3200. Buyers to get any, we need to rise above this falling trend line. So we'll be looking at around 3,330 and 3,365, sorry, or 65, there we go, which is the high for this past week. They're levels to be watching out for. Just finally, let's talk about oil. We've got the OPEC meeting, where OPEC is widely expected to increase output or agree to an output of 411,000 barrels per day from July. That's a very solid increase, larger than what had previously been discussed, and could mean that oil prices remain under pressure, at least for the near term, because if we've got those concerns over increased supply at a time when there are concerns over the demand outlook, given the fact that the Trump tariffs are expected to be inflationary. So the outlook for oil remains concerning. We've seen that it has recovered off the low of the 5,500, but it's failed to make any headway above the 64 level. We're trading below the 50 SMA. That's where it's really capped any recent gains, although that we are finding support at that 60 level. So, and we've got the RSI neutral. It does seem that the price is relatively steady at these levels. I mean, as long as there are no surprises from the OPEC meeting, I think it's fair to say that the the 411,000 cut is pretty much priced in at this level. So it depends on whether there are other hints towards sort of further production increases, sorry, not cuts, in coming meetings that could disrupt or unnerve the price further. So as I said, levels to watch if you're looking for a break on the upside above the 50 SMA, 63.30, that was the high that we saw, sorry, 63, the high that we saw this week. Get above that, then we'll be looking more towards the 65 level. On the downside, talk about increased supply, any concerns from weak non-farm payroll data, weak ISM figures, weak data from China, then we could see a break below the 60 level. That's going to bring the 55 level back into focus. So that is everything from me. I hope that you've liked it. And if you would like any more information, then do to like this video and subscribe. And otherwise, we will see you next week. Thank you.